In the spring of 2023, the hallways of the Federal Reserve's San Francisco headquarters felt less like a center of global finance and more like a room where a slow-motion train wreck was being watched through a thick pane of glass. For nearly 2 years, supervisors had been looking at Silicon Valley Bank's balance sheet and seeing red flags that were practically neon. The bank was growing at a breakneck speed, its deposits doubling in a matter of months, while it funneled that cash into long-term treasury bonds that were losing value every time the Fed hiked interest rates. By the time the bank finally collapsed in a staggering $42 billion bank run that lasted just 24 hours, the post-mortem report from Michael Barr, the Fed's vice chair for supervision, was blunt. He didn't just blame the bank's management. He pointed to a deliberate, sluggish culture of oversight, a deliberative process that required absolute certainty before anyone pulled the emergency brake. It was a classic case of regulatory lag, the time it takes for a problem to be spotted, for a committee to agree it's a problem, and for an enforcement action to actually hit the desk. This delay isn't just a bureaucratic annoyance. In the high-stakes world of global economics, that gap in time acts like a magnifying glass for disaster. When a regulator waits for the perfect amount of evidence to act, they aren't just being cautious, they are inadvertently feeding the very monster they were hired to slay. This is the paradox of the regulatory feedback cycle. Most financial oversight is designed to be a balancing feedback loop, much like a thermostat that kicks on the air conditioning when the room gets too hot. But when there is a significant delay in that signal, the system doesn't just fail to cool down, it overcompensates, oscillates, and eventually the heat builds up so much that the whole machine explodes. To understand why this happens, we have to look at the mechanics of how these delays transform a simple market correction into a systemic meltdown. Think back to the lead up to the 2008 financial crisis. Between 2000 and 2003, the Federal Reserve dropped interest rates to historic lows, which sparked a massive boom in the housing market. Institutions started targeting low-income homebuyers with subprime mortgages, loans that were often designed to fail once the introductory interest rate expired. Regulators saw this happening. They watched as mortgage-backed securities and complex derivatives began to weave a web of risk across the entire global financial system. But the response was caught in a cycle of light-touch supervision. In 1999, the repeal of key parts of the Glass-Steagall Act had already blurred the lines between boring, safe commercial banking and high-risk investment gambling. For years, the signal that something was wrong was ignored or debated. By the time the alarm was finally sounded in 2007, the rot wasn't just in the walls, it was in the foundation. Because the regulatory feedback was delayed, the correction wasn't a gentle nudge back to stability. It was the collapse of Lehman Brothers and $1 trillion in losses that nearly wiped out the global economy. The technical reason for this amplification lies in what engineers call phase shift. In a healthy system, a negative feedback loop applies a correction that is exactly opposite to the disturbance. If the market is too exuberant, you tighten the rules to slow it down. But if your response is delayed by a year or even a few months, you might be applying that slowing force just as the market is already naturally starting to dip. Instead of balancing the system, you've now added your downward pressure to the market's own downward momentum. You've turned a stabilizing negative feedback loop into a destructive positive one. This happened vividly during the Great Depression. The economic downturn began in late 1929, but the Federal Reserve didn't just fail to provide liquidity, they actually adopted a restrictive, tight money policy in 1930 and 1931. By reacting to the previous decade's excess after the crash had already begun, they turned a recession into a decade-long catastrophe. They were fighting the ghost of a boom while the reality of a bust was already at their doorstep. The same pattern emerged with Silicon Valley Bank. In 2018, Congress passed a law that rolled back some of the Dodd-Frank regulations, specifically exempting banks with less than $250 billion in assets from the most rigorous stress tests. SVB was a primary beneficiary of this. Because it grew so fast, it missed its 2021 supervisory stress test entirely. Regulators were essentially flying blind during the most volatile period of interest rate hikes in 40 years. Even when supervisors did spot the risks, they spent months in deliberative cycles, writing reports, asking for more data, and waiting for the bank's board to respond. During that delay, the bank's vulnerability wasn't static, it was compounding. Every day the Fed raised rates, the value of SVB's bond portfolio dropped further. By the time the regulators were ready to enforce a change, the bank was already insolvent. The delay didn't just miss the window for a fix, it allowed the imbalance to reach a point where the only remaining option was a total government-backed rescue to prevent a wider contagion. This leads us to the regulatory pendulum. After every major disaster, there's a frantic rush to over-regulate. We saw it with the Glass-Steagall Act after the Great Depression, and we saw it with Dodd-Frank after 2008. But as the memory of the crisis fades and the economy enters a new boom, the political pressure for deregulation builds. This is where the delay becomes systemic. In the IMF study of regulatory cycles, researchers found that governments often engage in pro-cyclical policies, actively weakening regulations during a boom to keep the good times rolling. This creates a legacy where the rules of the game are always one step behind the reality of the market. We are constantly using the blueprint of a last crisis to try and prevent the next one, which is like trying to drive a car while only looking in the rearview mirror. In the case of the 2008 crash, the focus was on subprime mortgages. By the time 2023 rolled around, the system was much better at handling mortgage risk, but it was completely caught off guard by the boring risk of treasury bonds in a high-interest rate environment. The delay in recognizing that the risks had shifted, and the delay in responding once they were identified, meant that the system-wide amplification was already baked in. When the FDIC and the Treasury had to step in on a single weekend in March 2023 to backstop every depositor at SVB and Signature Bank, it was a move of pure desperation. It was a sign that the regulatory feedback loop had failed so completely that the only way to stop the spiral was to discard the rules entirely and flood the system with liquidity. Ultimately, the delay in regulatory feedback cycles functions as an accidental accelerator. By the time a risk is proven to the satisfaction of a committee, it has often already moved from a manageable problem to a systemic threat. The lesson from these recurring disasters isn't just that we need better rules, but that we need a different kind of timing. A system that waits for absolute certainty is a system that is destined to be too late. Until we can close the gap between seeing the smoke and pulling the alarm, we will continue to find ourselves standing in the ashes of economic disasters that were, in theory, preventable. If this look into the hidden mechanics of financial cycles changed how you see the news, pass it along to someone who values the stories behind the data.